Today, folks, as many of you may be aware, I've been going through this nature of conservativity because we recently just purchased a piece of real estate about a month and a half ago. And before that, I had to come up with the funding, and I had to do it through selling stocks in my tax advantaged accounts. And I didn't want to get caught in the volatility of the market. But now that we're in this place of basically stability, we just paid another $30,000 off the mortgage. We have a very healthy emergency fund built up. And as my corporate accountant advised me, it might not be the most opportune thing to be doing is buying dividend stocks within those accounts. I'm looking at retopping up some growth vectors, and I have two stocks particularly on my mind that I just want to talk about today, with the first and foremost being Google. Google is kind of blowing my mind. The more I dig into this company, the more I want to have exposure to it. Google, even at these levels, I think are an incredible buying opportunity. Not only the fact that they're hitting, record revenue growth. I mean, you compare this to many tech companies like Apple that's seeing declining revenue growth. Google has a moat beyond anything I think people can appreciate. We'll start first and foremost from the entertainment side. Unlike traditional media that's fighting for the streaming industry, we're seeing companies like Walt Disney start to double down on their higher margin businesses like their parks. They're investing billions of dollars into their parks to try and get that moat built back up, because it's hard to compete in streaming where you have to take all your crazy huge brands like Marvel, like Star Wars and all this stuff, and you have to condense it and make more and more and more and feed the addiction of people because they just get bored so quick and move on to the next thing. It's hard to keep that sticky moat, and Disney's just fighting aggressively for that right now, whereas YouTube in the social media sphere is exploding beyond imagination right now. You look at somebody like Mr. Beast, who just came out on Forbes with the top 2023 creators making $54 million, which is so damn conservative. This dude is making way more than $50 million. This guy's running $1 billion brand, and in fact, he just got invited to the board of Forbes. We're seeing new celebrities, new stars that are ever creating content and keeping that addiction filled on social media, not on traditional platforms and streaming. Now, I love Disney from the aspect of what they're doing with their business right now. I think it's appropriate, as much as people don't like them reinvesting in their higher motive businesses. But from traditional media, I don't want really anything to do with it. It's why I'm not the biggest fan of Disney, because it's so cyclical. But YouTube doesn't have that cyclicality problem because people always find new creators and they love following them for long periods of time. But putting the creators and the media business and YouTube and social media aside, I am really much more fixated on the future of what I believe is going to be one of the largest market cap opportunities, which is self-driving. And right now, Google arguably has a better moat to that, in my opinion, than maybe even Tesla does. Tesla's still fighting to build this out as a broad-based system, whereas Google actually has, cars fully autonomous that you can hail right now in places like San Francisco, and they're expanding that as they core focus on specific areas and building out data sets where they can operate this efficiently and safely today. And that is extremely scalable, because once they have it working, it's easy to adopt this on as many cars as they'd like. Now, I don't know if Waymo would be the primary leader in self-driving, because Tesla has much more scale capability, but they are going to be in the top players of this industry, in my opinion, and you can get direct exposure to this today. And nobody talks about Google Waymo. Like, it's an in passing conversation in comparison to Tesla, but Google, man, it is making my mouth drool, and I'm looking at cost averaging into stocks like this now in my corporate account into the end of the year until I can start topping up my tax-free savings account. And even as of recently, one of my favorite investors of all time, being Bill Ackman, recently talked about Google, and you can listen to what he even had to say about it.
Alphabet is one of your more recent investments, is that correct?
Yeah, we bought it late last year, early this year. Yeah, or early this year.
How much did that have to do with AI?
It had a lot to do with AI, because AI was the reason why the stock was cheap, right? ChatGPT was launched, incredible, game-changing kind of product, and Google really fumbled their offering. And so people said, oh my God, Google's way behind on AI, and the stock sold off to 15 times earnings for one of the greatest businesses in the world. And we did a fair bit of work, but Google's been almost a decade. They bought DeepMind, huge, spending billions and billions of dollars on AI. It's a company known for hiring great engineers, and you could certainly presume they were at a pretty good place on AI. But they're, again, very different from a startup. They took a much more cautious launch approach, and then kind of fumbled an early demonstration, made people think they were behind, and Microsoft and ChatGPT would sort of, if you will, OpenAI would eat their lunch, and it led to a very mispriced stock. And then we've bought more in the 120s. It's our second largest investment.
Now let's get into numero dos here, and that is going to be Tesla. I made so much money in 2019 up till about 2021 owning this stock and just taking my profits out of them. And I keep putting price targets on this because I'm very skeptical of Tesla. I said, look, the day they make revenue off self-driving, I don't care what the value of the stock is, I would buy it. But I'm kind of getting back to a place now where I want to get back into Tesla because I said, at the end of the day, these stocks are always going to be highly valued, and it's easier if you love the company enough just to cost average buy the highs, buy the lows, and just buy into it for over a year. But what I'm going to do is wait till these next quarterly earnings because I just want to see because I just don't think this next quarter is going to be great, and I just want to see how the market digests it. But you can't help but recognize at this point, if you're listening to somebody that's saying Tesla's just a car company, those people are absolutely morons. They have no vision into the future. They have no idea the value of IP or having insane engineers and staff and building technology like these robots. I have no idea what the value of the potential of these robots are going to be, but Tesla's got such a broad, diverse moat of innovation going on that is only comparable to the large tech companies like Google, like Amazon, and like all these other companies. So I want exposure to this for the long term. And again, I know Tesla's an expensive company today, but because I'm so young and I have such a long time horizon and I'm back in a place of stability where I'm not as conservative in my nature, I don't mind making this a small percentage of my portfolio. I'm just looking for 2 or 3 primary growth companies in the mega cap range of things outside of the small cap exposure I have, just for that potential to continue to outperform the markets. And I still think Tesla, even at these current values, if you're looking at a long enough time horizon, from my personal vision and perspective, I know you can argue with this, you can look at all the numbers today and say it's too expensive, it's too this, it's too that, but again, I'll be one of those people that will end up putting my money where my mouth is. And if you want those updates when I buy these stocks, you can always consider subscribing for that. But as Meet Kevin said, and I hate referencing Meet Kevin, Tesla's one of the few mega cap companies that's actually underexposed by most ETFs. I looked at a lot of ETFs, growth ETFs, especially over the last month, and I was kind of shocked to see how many of them either underweighted or didn't have Tesla in them at all. And you can see that by the institutional ownership. It's still relatively large at 44%, but in the realm of these mega caps and sitting, in the top 10 or 20 companies on the S&P 500, it's really underexposed compared to Google that sits at 62%. Apple's, institutional ownership sits at, where's their institutional ownership here, at 61.3%. You got Amazon here at 60.53%. And you want to know how NVIDIA exploded so dramatically? The institutional ownership is 68%. And as I've mentioned, this is a huge critical factor to buying companies because you look at things, as I've talked about recently, like the sin sector with, say, MO or British American Tobacco. Those companies will never have any growth potential into the future because there will never be institutional ownership. And at the end of the day, when your stock gets so large and you're talking about the tens of billions of dollar range and no institution will touch you, the fact of the matter is most of the return is likely to come from dividends. It's sad. I know earnings aren't the end all be all to growth in a stock, but these are things that I'm noticing, and I can't help but think that Tesla at some point, if they actually prove a lot of these growth vectors or some of these things come into play, institutions are going to pick it up. And if you see how much institutional ownership are in these mega cap companies, there's another 15 or 20% room of growth just from institutional ownership percentages. And that's just me speculating and just putting something out there. But outside of that, there is one other stock that I absolutely love that I'm not buying because my fiance has large exposure to it. We have good exposure to Meta already. Meta just launched the Quest 3, and I will absolutely be buying this. I absolutely love their VR platforms. It's going to be neat to see how they compete with Apple, considering Apple is trading at a price point that I think is that most people just can't afford and most people won't be buying, and they'll be turning to Meta to play games and actually doing things in the real metaverse, unlike Apple that I think is going to be more based just for engineers and just app developers for right now. So Meta I'm going to be paying a lot of attention to here, especially in the upcoming earnings. I think you can pre-order the Quest 3 now, and they're going to be shipping on October 5th, I believe, here in Canada. And then it'll be neat to see as we go through the holidays what those sales actually look like. But something tells me Meta's going to be selling a lot more volume than Apple is when they drop theirs at the beginning of next year. And Meta's already kind of at the gate, right? Apple's going to have a hard time, I think, catching up from a price point perspective. But it'll be neat to see this VR fight and who actually comes out on top. But I already got decent exposure to Meta, so I'm not looking to buy that one here. But these are kind of the growth stocks that I'm looking at and my thinking around them as it stands today, as I start kind of moving away from this conservative nature back into a place of stability where I can start seeing growth start playing a bigger place in my portfolio. But I'd love to know what you think in that comment section below.